Good morning, everybody, and welcome to our autumn budget debrief. I hope everybody's well, and obviously got quite a lot to go through based on the announcement on Wednesday. Just a bit of housekeeping first. If you are unable to hear anything via your computer or audio, on screen are the login details via telephone and the access code to be able to access that accordingly. I apologise in advance if there's any technology issues. We should be absolute dab hands at this now, but I do apologise if there is any of those issues. So for those who don't know me, I'm Phil Hartley. I am one of the tax directors at Mitchell Charlesworth. I've been with Mitchell Charlesworth for 6.5 years now, and I've worked in tax in general for over 10 years now. I predominantly work within the corporate tax side of things, but obviously within Mitchell Charlesworth we cover all tax bases, including your inheritance tax, capital gains tax, employment taxes, etc., etc. Please don't hesitate to ask any questions during the webinar. You can use the chat function. I won't answer these during the webinar, but I will answer them where possible at the end of the webinar. And if I don't answer your question, I will make sure I come back to you outside of the webinar experience. And you can always contact me just directly after the webinar should you wish to. My email's on screen there now, but it will also be on the screen at the end of the webinar as well. Session's being recorded, so it will be circulated along with the slides following the webinar. So what could we talk about today? So I'm just going to do a very quick recap on some of the things we already knew were happening prior to the budget. We're going to do income tax changes. So particularly, we're going to focus in on employers NI in that respect and the 1.2% increase that was announced. We're going to just make sure and discuss about a salary dividend remuneration package. And is that still appropriate? Is that still the best way to remunerate an owner-managed business shareholder? I'm going to recap on stealth tax as well. It's been in the news a lot, particularly with the frozen thresholds and what does that do and the impact that has. Then we'll talk about capital gains tax. So what were the changes that were announced and what do they ultimately mean on a capital disposal moving forward? And very similar within inheritance tax position, what will those changes mean as a result of what was announced in the budget? On corporation tax, although not something specifically announced, there was the corporate tax roadmap that was announced. So I'm going to give you a bit of overview of what that means and how that could impact businesses moving forward as well. Bit of a quick overview of some of the other matters that are announced in the budget and then any questions at the end. So what do we already know following from previous announcements? We knew that the tax thresholds for income tax purposes were remaining frozen until April 2028. The dividend allowance was at £500 and that was being maintained at that level prior to the budget. Annual exemption for capital gains tax at £3,000 and that was being maintained at that level as well. And the corporation tax was going to be a maximum of 25%. That was maintained by the previous government, but also a manifesto pledge by Labour as well. We did also know that finished holiday lettings relief was being abolished from April 2025. And was previously announced that vehicle excise duty will apply to electric vehicles from April 2025 as well. And we already had announced that VAT will be applied to private school fees from the 1st of January 2025. So income tax and national insurance changes. Although, as widely reported, the Labour manifesto promised no increase to income tax and national insurance. There was quite a lot of speculation, particularly employers NI, and extending the freeze on the income tax threshold, potentially by 2 years was a lot of that talk. The good news was that the thresholds weren't extended, so they will only be frozen until April 2028. But the bad news for many business owners is that the rate of employers' national insurance has been increased. That's been increased to 15% from its current rate of 13.8%. And that will apply from April 2025. At that same time, almost it's a double whammy because the threshold at which you start paying employers' national insurance per employee will reduce from £9,100 to £5,000. So that's quite a significant drop in that essentially national insurance free threshold per employee. On the flip of that, we had the employment allowance that was increased from 5,000 to 10,500, and also the cap on that was removed as well. So previously we had a cap where your bill was over £100,000, you didn't were unable to claim the £5,000 employment allowance. Now your allowance has gone up to 10,500, and you can claim it even if you're over and above £100,000. So a minor, hopefully, benefit for some of the bigger businesses that were unable to claim this previously, but the knock-on of the increase in rate and the reduction in threshold will have a significant impact. As I mentioned before, income tax thresholds have not been extended to be frozen, so they will be frozen until April 2028, but I'll dive into a bit more details what that means with the stealth tax section in a moment. And one of the other speculations was about dividend tax rates. Could they change? Obviously, with the debacle around the definition of a working person, but there were no changes made to dividend tax rates in this budget. So, what does the increase in the rate of employers' national insurance and the reduction in the threshold that you start paying it mean to a business? Now, the example I've got on screen doesn't take into account the impact of the employment allowance. I've ignored that in the context of this calculation, but you can just see on the left hand side you've got a salary level and what's the cost from an employer's national insurance perspective pre-April 25 and a cost post-April 2025, and you can see there it's a significant increase. So a worker on a £30,000 salary is going to cost an additional £866 per year in employers and national insurance to employ that individual, and it only goes up the higher the salary goes. So the cost is a significant cost, and it is going to impact obviously employers and decisions really around pay, potentially about recruitment as well. It's going to have a wider knock-on effect in my view. In terms of some of the other income tax changes, is the salary dividend package still correct? Is that still the way to go forward as an owner managed business individual? So this comparison, I would point out, is based on the same cost of the company being incurred. So we do calculation that shows, well, this is the cost of the company of a £30,000 salary, for example, and what at the same cost of the company can you extract net as a salary and dividend position. And as you can see here, with your right-hand column, it is still very much beneficial for owner-managed businesses to still extract as a salary and dividend move in the 25-26 tax year. What I will point out at this stage is that previously we were advised that a salary of £9,100 should be taken, and that would previously, or pre-April 2025, have qualified you for your state pension credit, but you wouldn't have paid any employer's national insurance. What will change is that salary, although probably can come down to a figure of £6,396 per annum, there will be employer's national insurance due on the amount over and above £5,000. So that's something to factor into planning moving forward as well. But you can see that it is more beneficial still, and there is still a high enough net income difference to be extracting salary and dividends. But interestingly, if you compare tax year to tax year, there is a bit of a difference, and actually an unexpected gain in some instances in this regard. As you can see there, if you've got your £30,000, £40,000 and £50,000 gross income level, actually there's a slight drop in that income, net income in hands, and that's because although the cost to the company has increased as a result of the increase in employers' national insurance, the gains offset by the employer's national insurance bill that you will pay on that excess over £5,000. Once you go over the 50,000 limit, actually you start increasing in your net income position as shown below. So potentially a benefit not thought through in that respect, but something that can be thought of and planned about moving forward as well. So stealth tax, and I covered this topic in our last webinar in March on this, and I just thought it was still important probably just to refresh ourselves in terms of what is a stealth tax and what does it mean. And in particular, this is in relation to the freezing of the income tax thresholds and the personal allowance. As we said before, it's not been extended, but it is frozen until April 2028 as it stands. And the problem that creates in terms of a worker problem, but a benefit for governments, is that although you've frozen the thresholds, wages are rising with inflation. And we've had obviously some significant rises in inflation in the past 2 years in particular. So what this effectively is doing is dragging people into higher tax rate bands. So you may have an individual that is a basic rate taxpayer that's been dragged into being a higher rate taxpayer, for example, or is being dragged into a position where they're losing their personal allowance, or being dragged into additional rate, or be dragged into tax in general. So although their income's rising, it's in real terms more tax is being paid on that income than it would have been if allowances and thresholds had moved with inflation as well. So on the next slide, I'm just providing an example. So the thresholds were frozen from April 2021 through to April 2028, and I've assumed that over that period in time, an inflation of 30% has been incurred. The first will demonstrate the effective tax rate if the bands had raised with inflation, and then the second will show how the band's been frozen has affected the tax rate. It doesn't factor in national insurance, so this is just purely focusing on income tax at this moment in time. So example 2021-22, this was the tax liability that would have been had on various different levels of salary, and you can see there the effective tax rates accordingly on the right hand side. Now, if you increase the bands along with the increase in the income, so for example, our 30,000 income has now become 39,000. Yes, the tax does increase, but if you note, the effective tax rate has remained the same in all bar one of the examples, which was the 100,000 going to 130,000. That's slightly increased in effective tax rate, but in the main, the effective tax rates have remained the same. Whereas an example of the impact with no change in threshold shows actually your tax liabilities have shot up and your effective tax rates have increased as well. So that, I think, demonstrates the impact the stealth tax has. So if we just go back a slide and look at your £39,000 scenario, about 4,500 worth of tax, and that's going to ultimately end up being, in my example, about 5,300 in tax. So that is a significant increase in tax liability than it should have been had the thresholds and the allowances moved with the inflation of wages as well. So big knock-on effects, and this is where a lot of talk around stealth tax and not doing anything in that nature isn't benefiting working people, because it's working people that can get hit by this very much in the future. So capital gains tax, and there was a few changes announced here, as along with various different other areas. There's been a lot of speculation in the past few months about capital gains tax, and a lot of actions being taken by business owners, by property owners in anticipation for what the changes could have been. At one point, there was talk of the capital gains tax rate increasing to 39%. So in that context, the changes weren't as big as had been speculated. The headline rates of capital gains tax have gone from 10% and 24%, 20% even, sorry, to 18% and 24% for all capital gains. And it's important to note for all capital gains because residential properties were already being taxed at that rate. So their rate of tax has not changed. And it's almost, we're equalizing share sales, commercial property sales, for example, with residential property sales. There was a lot of talk about potentially business asset disposal relief, or previously known as entrepreneurs relief, being scrapped. But that has been maintained, but the rate of relief is substantially reducing over the next 2 tax years. EIS and VCT reliefs, they've been extended through to April 2035, so that provides a bit of certainty surrounding those reliefs. We normally get a couple-year extension at a time, but now we have a 10-year extension. And there's been quite a few administrative changes made to employee ownership trusts. So that's some of those headline ones, including confirmation that payments to EOT will not be subject to income tax. Previously, we've had to go and get a non-statutory clearance to confirm that position. It sounds like it's going to be made legislation by the government. And an emphasis on trustees to ensure market value is used for the purchase of the shares. So shifting the emphasis, I would say, there from the owners exiting through an EOT onto the trustees who are looking after the interests of the employees to ensure market rate is being applied on the purchase of those shares. So as an example, just a bit of an example, a bit more of an overview in terms of the rate and the business asset disposal relief in particular. So as I just mentioned before, prior to the budget, gains on shares and on commercial properties or commercial properties were subject to 10/20% capital gains tax. That depended on your on your income tax rate bands and if you were a higher rate or a basic rate taxpayer. Business asset disposal relief applied a 10% rate on the first £1 million of gains that qualify for the relief, and a lifetime allowance of £1 million applies. As of the 30th of October 2024, the rate for the capital gains tax rate changed. So there's not a bit of a run-off period until those change. They changed as of budget day, and they changed to 18%/24%. Business asset disposal is stayed at 10% and on the first £1 million of gains and a £1 million lifetime allowance, and that applies till April the 6th, 2025. At that point, the rate of relief for BADR will change, so that will increase to 14% instead of 10%, and then there's a further increase to 18% on the 6th of April 2026. So ultimately the relief, the rate that you will pay on assets that qualify for business asset disposal relief will equal the lower rate of capital gains tax by the 6th of April 2026. So what is the impact of those changes and how does it flow through? So there's a couple of slides like this now, and the first one is, okay, what's the changes pre 30th of October compared to post 30th of October? And you can see the level of gain up to £1 million. The tax position in the next 5 months won't change. This, just to point out, it's an example based on annual exemption allowance being available of £3,000 and assumes the full lifetime allowance for business asset disposal relief is available to us. So 500,000 to up to £1 million, the tax position won't change post 30th of October 24 up to the 5th of April 2025. But you can then see that post £1 million gain, the tax is increasing accordingly. So ultimately, every £500,000 over and above £1 million, you're paying an extra £20,000 in capital gains tax than you would have done. In the next scenario, this compares its pre 30th October 2024 to 2025-26. So big difference is that now gains under £1 million are going to pay additional capital gains tax, and as you can see, that figure on the right hand side is only getting bigger depending on the level of gain incurred and compared to the last schedule. And then you can see now this is impact comparing pre 30th of October 24 to the 2026-27 position, and again significant increase. So we've gone from paying, for example, on a £5 million gain, we've gone from paying £900,000 in capital gains tax for an individual to paying £1.14 million in capital gains tax. So that's an increase of just shy of £240,000, which is a significant increase in the position and something that needs to be considered. I think the knock-on effect, potentially, we've had a big run up to the 30th of October, and potentially we're going to have another big run up in terms of business owners and property owners deciding what they want to do up to the 5th of April 2025, to potentially, particularly if they can utilise business asset disposal relief at 10%. I think there's going to be another big run up to that. in terms of potential a lot of transactions occurring and a lot of business owners deciding what they want to do next. Inheritance tax. So again, as with capital gains tax, a lot of speculation surrounding inheritance tax and significant changes that could be made. I think the good news from the budget, if you can call it good news in that sense, is that there was no change in the main rate of inheritance tax, so that's remained at 40%. It hasn't increased, and there wasn't any change in terms of the length of time a gift remains within your estate, generally known as a 7-year rule. There was talk that could go to 10 years, but that has remained at 7 years for now. However, the thresholds for inheritance tax, the freeze on those thresholds. So we have a nil rate band of 325,000 and a residential nil rate band of 175,000. That freeze has been extended. So it was meant to stop in April 2028, and that's been extended to April 2030. So similar to the example I used with income tax, that's dragging more assets into the sphere of inheritance tax than would have been if the bands had increased with inflation as well. Some of the big changes, firstly, pensions. So although there wasn't any other announcements on pensions in terms of potentially reduction in the amount you can take out tax-free, as an example, one of the big announcements regarding pensions was that unused pensions within an individual's estate from April 2027 will be subject to inheritance tax. And I think the other point to mention there is that the pension fund will be liable to pay the liability. A lot of the press and articles around this point are quoting quite a high tax figure on this, and I think that's a justified percentage as well, because it's taking into account the inheritance tax you'll pay, plus then individuals extracting that out, or beneficiaries extracting that out in the future. Big tax implications of that, in my view. And there were significant changes announced to business property relief and agricultural property relief from April 2026, which I'm going to go into a little bit more detail on now. So based on current rules, the assets that qualify under business property relief or agricultural property relief, they receive either 100% or 50% relief on the full value of the asset. And there's definitions of which assets qualify for 100% relief and which assets qualify for 50% relief. From April 2026, those rules will change. So the relief available will be restricted compared to the current position. And the first £1 million of asset value under these categories will continue to receive 100% relief. I think what's important here, and is very much in the HMRC guidance and government guidance that's been released post-budget, is that £1 million is combined. So it's not £1 million for business property relief and £1 million for agricultural property relief. It's £1 million combined. So you may have an individual that's got both assets that qualify under both. They'll get £1 million. They won't get two in that respect. Then the value over and above £1 million will receive 50% relief. And so in the budget, she was quoting effective tax rate, inheritance tax rate of 20%, and that's because the relief will be 50% over and above £1 million. I think what's important to note here, this and the change in the pension position, is actually the knock-on effect this could have in terms of the value of the estate, and equally in terms of the ability to claim the residential nil rate band. And so just as a little bit of background and context, an individual allowed to claim the residential nil rate band, but if their estate is over £2 million, you start to lose that residential nil rate band until you've lost it in full. Now, previously, your pensions, your assets qualifying for business property relief or agricultural property relief wouldn't be counted in the value of that estate because they were effectively exempt from an inheritance tax position. Now that they're not, and particularly with the pensions, you're bringing that full value of unused pensions in, you're bringing a value in for business properties or agricultural properties, and you are now potentially creating a position where your estate is going to be over that £2 million potentially. And you've now potentially, as well as having to pay inheritance tax on the assets you didn't think you would have to pay inheritance tax on previously, your bands might well come down as well to just to 325. It's an individual, potentially 650 if it's a husband and wife, for example, where husband or wife has transferred all the assets over to surviving spouse. So I think there's going to be a lot of planning and a lot of consideration moving forward that's going to be required with inheritance tax, and thinking about what is your estate position now post rule changes, or what will it be from April 2026, and what will it be from April 2027, and is there anything you can potentially be looking at and doing to restrict that position moving forwards. The corporation tax, as I said earlier, there wasn't any specific area of corporation tax where they said we're going to do X, Y, or Z. But what they did announce was there's going to be a corporate tax roadmap. And the aim of this roadmap is to try and provide stability to businesses over the main and key areas of corporation tax. And whilst also then saying, look, we're going to look at certain other bits as well over the period of this parliament. So I've read the roadmap, and some of the pledges that included in there were that there will be no change to be made to the main rate of corporation tax. So that's the 25% rate. That isn't going to change according to the roadmap. That the small profits rate of 19% and marginal relief will also be maintained. That didn't say specifically it will be at the same level. So at the moment you could have, if in profits are up to 50,000, you tax at 19%. If they're above 250, you tax at 25%, and in between there's a marginal relief position. So those figures weren't quoted as being stable. So there's potentially an area where they could change, but the main rates and the marginal relief will stay the same. There's a pledge to maintain capital allowances, including full expensing and annual investment allowance, whilst also they're hoping to explore providing more clarity on what qualifies for capital allowances in particular, because it is quite a minefield in that respect of what can and can't qualify, and expanding on full expensing for assets bought for leasing or hiring purposes. So that's not set in stone, that's going to happen now, but it's something they're going to have a look at, because at the moment full expensing is not available to assets bought for to be leased or hired out to third parties. Annual investment allowance though is, so that's still a relief that can be claimed. And they've pledged to maintain R&D at their current rates, and they're going to consult on the ability to potentially provide more advanced clearances for R&D claims. At the minute, advanced clearance is only available in very limited circumstances for R&D tax relief. So I think that's something that's important and would provide a lot more clarity on R&D moving forwards. They've pledged to maintain patent box tax relief, effectively reducing tax rate on profits made as a result of a patent by 60%, which is a significant relief, and to maintain an audio-visual expenditure credit and a video games expenditure credit. So I think what's important there is actually that doesn't expand any further on some of the other creative industry reliefs we have. And they've specifically said those two, but they haven't mentioned, for example, museums or orchestras or theatre tax reliefs that are available. So that's something to be thinking about and considering as well moving forwards. And to further consult on changes to transfer pricing, and in particular moving the UK to a UK requirement was mentioned as well. Overall, I think the corporate tax roadmap provides a bit of clarity on the government position, but when you read the document, it's still a bit vague and definitely needs a bit more meat on the bones to ensure that the stability that businesses need is actually met moving forwards. Stamp duty land tax. So we have widespread rumours about reducing the bands when SDLT is due, but that didn't come to fruition in the budget, which is a positive. But one thing they did pull out the bag, or as I put out the rabbit out the hat in the budget, was that the change to the higher rate that's paid on second homes or by companies has been increased to 5% from 3%. Equally, properties purchased by companies and what they class as other non-natural persons of a value over 500,000 will be subject to 17% rather than 15% moving forwards. So the above changes really are increasing the cost of expanding a buy-to-let portfolio or companies investing in residential property. And as an example, again, I put the value of the property on the left-hand side, and the SDLT pre-31st of October 2024, when the change was effective from. And previously, you can see if we pick on the £250,000 scenario, that rate was amount of tax was £7,500. That's increased to £12,500 post change in rate. So again, additional cost per property that's being incurred, and only going to get worse as a higher value you go, particularly with it now being 17% over and above £500,000. Just some other points to consider. So national living wage has increased to £12.21 per hour from the 1st of April 2025, with a significant increase to national minimum wage for all rates as well. 18 to 20, for example, will be £10 per hour. Tax treatment of carried interest. A lot of talk about this, and not necessarily something that potentially people here will be too interested about, but that will be subject to a 32% capital gains tax rate from April 2025, and then with a pledge to make it part of the income tax framework from April 2026. Electric vehicles, so we mentioned earlier about road tax being due on electric vehicles from April 2025, and they've also now started to increase the benefit in kind on a cost of an electric vehicle. So at the minute it's a 2% BIK on the list price of the vehicle, subject to then income tax and subject to Class 1A national insurance. That will by 29-30 increase to 9%. So that's quite a significant jump over the next few years and something to be aware of. Mentioned before with the private schools, VAT definitely being implemented from 1st of January 2025. I know there's a legal challenge to that being announced today in the press, but as it stands, that being implemented from 1st of January 2025, and business rates relief that's available to private schools under being classed as a charitable activity is to be removed from April 2025. Quite a bit of announcements on business rates. So they included changes to include lower multiples for retail, hospitality and leisure properties, along with a 40% relief in that sector as well. And higher multiples on properties with a rateable value over £500,000. So that's in the hope to catch more of your Amazon warehouses, for example. We've got tobacco duty, alcohol duty, air passenger duty changes as well. So overall, the budget overall provided £40 billion in tax rises, which is the highest level since 1993, and the Black Wednesday impact that had. Of that £40 billion, £25 billion is accounted for through the employer's national insurance increase. And although the manifesto for Labour said we wouldn't impact working people, it has now been admitted that this will impact working people. As I mentioned before, lower wage increases, for example, impact on recruitment could all be factored in with this change. The changes to capital gains tax will undoubtedly accelerate plans surrounding exit for some business owners. Some business owners may have been thinking about it in the next 18 to 24 months, and now think I actually might want to start looking at that sooner rather than later to benefit from a lower rate of capital gains tax. And then with inheritance tax, more planning will definitely need to be considered around that, given the changes to BPR, APR, and pensions. I know, for example, my parents said they need to spend their pensions, which doesn't seem an unreasonable route to take moving forward. And then, other than the inheritance tax change, which obviously big enough in its absolute own right, there wasn't any impact on pensions relief at all, other than the inheritance tax position. And I wouldn't be surprised if they come back to that in the future. I think there's a bit of an issue they have there with public sector and private sector pensions. And I think it's something they will look at and consider eventually. So we'll just go to the questions part now, and I believe we've got some come through, so I'm just going to have a look on my screen. So I've got a question here. If a farm with a sole ownership with a value of 1.8 million has been transferred in the last couple of years, will the APR/BPR still be available if the farmer dies before the 7 years is up? A really good question, and actually the guidance is quite clear on that in terms of if the gift happens post 30th of October 24, before 5th of April 2026, and then the farmer passes away post 5th of April 2026, the new rules will apply. But if it happened prior to that, the gift happened prior to that, the old rules would apply. So yeah, really good question, and one of the nuances with that position, and definitely something to have a little bit more of a think about and consider in due course. I will just see if any more questions do come through. So one of the questions is the cap on employment allowance of 100k. When will this be removed? From my reading of the guidance, that's when the new higher rate of employers' national insurance will come through. So my reading is that's from the 6th of April 2025. So it's not immediate. There's still another few months till that change is implemented. I can see at the start of a question on double taxation on passed down pensions, but there's not a lot of detail there. So I'll just leave that question for now. Just give it a minute to see if there's any more questions that come through. Doesn't look like there is, but as you can see on the screen, my email address is there. So if you wish to email me, please do. You can obviously also email your relevant partner that looks after your affairs, or one of my other tax colleagues, and we'd be more than happy to try and help and advise as much as we possibly can. I think we'll just double check. Oh, here we go. So one question is, does the additional SDLT apply in Wales? So Wales have the land transaction tax. I'd have to double check on that point and see if those changes do apply. The land transaction tax does have the higher rate associated with it, so it may well do, but I would need to just double check and make sure. Oh, and then the double taxation on passed down pensions. Why would I not draw all the pension now, pay 45% income tax on this, and then pay the net as a gift out of income? Good question. Something we probably have to consider in a little bit more detail. As you rightly say, it could be that is the way to do it. Obviously, you then have to think about when the timings of the gifts are, with that 7-year rule in mind, and it not being still within the estate. So something to have a conversation about for sure, and would be more than happy to do so. And I think that is it. So I'm going to stop it there. Thank you very much, everybody, for attending today. As I say, please do email me if you have any questions. I know just one's just popped up there, so I will try to respond to that outside of the webinar. And please contact either me or one of the team if you need to chat through anything any further. But thank you very much. Have a great rest of the day, and speak soon.